That global framework of capital we had in place ahead of the crisis obviously did not work, and we are moving quickly across the world to fix it. I want to describe briefly the key elements of the international agreement we're working to build. First, we're going to make sure that financial institutions hold a lot more capital than they did before the crisis. We want the new requirements to be set so that we could face a crisis of this severity in the future without having the government have to step in and provide emergency life support. The major banks will be required to hold enough capital so they could withstand losses similar to what we saw in the depths of this recession and still have the ability to operate without turning to the taxpayer for help. Second, we're going to make sure that firms meet these requirements with common equity so they can better absorb losses. In contrast to the rules prevailing today, which allow a wide range of other forms of capital, the new requirements will be set in terms of real common equity, tightly defined to mean capital that will truly absorb losses when firms get into trouble. Third, firms will be required to hold significantly more capital against the types of risky assets, trading-related assets and others, that cause so much unexpected financial damage in this crisis. Fourth, bigger firms and the more complex, interconnected firms will have to hold more capital relative to risk than will smaller banks. The largest and most interconnected firms cause more damage when they fail, so they need to be forced to hold more capital relative to risk. That is a simple principle of fairness, and will also help provide stronger incentives for firms to limit their size and leverage in the future. Fifth, these new capital requirements will be supplemented with new global standards for liquidity management so that firms can withstand a severe shock in liquidity without deepening the crisis by, for example, having to sell assets in a panic or cutting credit lines indiscriminately or needlessly turning to central banks for liquidity support, all, of course, which can undermine financial confidence in periods of stress. Now, under this framework that we are now working to build, firms will be subject to two tiers of capital requirements. Firms will need to hold a substantial minimum level of capital, and they will be required to hold an added buffer of capital set above that minimum. If a firm suffers losses that force it to eat into that buffer, it can do so, but it will have to raise capital, reduce dividends, or suspend share purchases. This will help make the system more stable over time, less pro-cyclical, in part by forcing banks to move more quickly to strengthen their balance sheets as the risk of potential losses increases in the future. Now, the most consequential part of these reforms, of course, will be the new quantitative capital ratios. We know that they have to be substantially higher than they were, but we also know that if we set them too high too fast, we could hurt economic recovery, or we could simply end up pushing the risk outside the banking system, something that could ultimately come back to haunt us.